earning high W-2 income and think there's nothing you can do to reduce your taxable overall income? Well, I would like to share with you some ideas on how they could possibly be reduced. So we know that your W-2 income is in cement. That's a non-flexible number, and that's going to go on line one of your 1040. So how about generating some negative numbers on other parts of the tax return that can bring that income down? There are so many tax laws out there to restrict that, right? We have active income, passive income, how you spend your time. So many things go into that. But I would like to share with you what actually does work. Number one, you know that you can put money in a tax deferred retirement account. What's happening is you're going to pay that tax later after you retire, right? And once you reach a certain age, you'll be required to take out required minimum distributions, RMDs. That will be taxed at ordinary income rates. And we don't know what the tax rates will be at that time, so it's a bit of a gamble. The other downside to that is that once you reach a certain age, you will be paying Medicare premiums. And every year, there's a letter that comes out from Social Security. It's called an IRMA letter. Most people don't catch that, don't read it, but it will tell you how much your Medicare premiums are, which is based on your tax return, based on your adjusted gross income. So if you're taking high RMDs, you're going to be paying Medicare. So there's a certain amount of planning that goes into all of those decisions. Number two, how can I reduce my high W-2 wages? Real estate has some possibility. Now, all real estate is deemed passive unless it meets certain exceptions. And what that means is that if you have a high W-2 income and you have passive losses, it's not going to offset your W-2 income. It's going to get suspended on that tax return and get carried forward. And generally, you won't be able to use that until you dispose of that property. So how can you make real estate activity active so that we have a negative number that's allowed on that tax return to pull down those W-2 wages? Well, the easiest way to do that is with a short-term rental, which means that the average stay of your tenant is 7 days or less, right? So you have to have great logs on the tenant stays. Now, let's say, those can be profitable businesses. So now we have another positive number on that tax return. So how can you generate a loss within that short-term rental business? Well, the most common way to do that is with a cost segregation study, which means that we're accelerating depreciation. But you don't just want to automatically jump into that situation without understanding certain long-term effects of that, because if you're going to sell that property sooner than later, then you're going to have to pay ordinary income tax rates, recapture that depreciation and pay ordinary income tax rates on that accelerated depreciation, which means that, you have a tax bill. So there's certain planning and certain questions that need to be asked before deciding to move forward with this. But we know the questions to ask. We know all the sets of all the right scenarios in which this makes sense for a taxpayer. Number three is probably the easiest of all of this, and those are the accredited investor strategies. Accredited investor is a real term used by our government. You can look that up on the SEC website to see the definition of accredited investor. And what that means is that you have a certain net worth or you're earning a certain amount of income. So for a single person, you have 2 years of tax returns that show 200,000 or more. For married filing joint, 300,000 or more. Or you have a net worth of 1 million, excluding your primary residence. Or you passed some pretty tough exams on finance. So let's just assume that you qualify as an accredited investor. What that means is that a whole world of tax planning has opened up for you. And it means that you can partake in investments that have inherent tax attributes that flow through onto your 1040 and can create negative numbers elsewhere on that 1040, overall reducing your taxable income. And there are a variety of these strategies. What's most important here is to be able to practice discernment on what could be held up under audit or IRS scrutiny. And that practice of discernment comes with higher education. It comes with understanding how the IRS looks at things, right? And so the person who knows how to do that is a tax professional. I see so many influencers online talking about tax planning strategies without a tax license. So here's the thing, that person isn't going to defend you when looking face to face with an auditor. That person is not signing your tax return and getting married to your tax situation, your facts and circumstances, and putting their stamp of approval on it. There are many nuances and details that you need to know to make these things defendable. And there are a lot of strategies out there that are undefendable and being talked about greatly. So we know how to practice discernment and how to say this has a high tax confidence level, this has a low tax confidence level, and why that is, right? So tax confidence levels are based on primary source citation. Primary source citation is coming out of government. For example, a private letter ruling, which generally can cost around $30,000, is specific to the taxpayer who ordered that private letter ruling. So you can't use that as defense on yours, but we do read them and we do understand them because it gives us a window into how the IRS views this specific tax situation. Tax planning is all facts and circumstances. And when you're taking, a high tax confidence level strategy, you want to make sure that that's appropriate for that individual taxpayer. Just because they're willing to get a short-term rental and willing to get a cost segregation doesn't mean it's the best choice for them overall. Yeah, we want quick wins in this tax year. We want to lower our tax in this year, but we also want to think about the long-term ramifications, right? So we like to work with clients by looking forward and looking ahead and understanding what are their goals? When are they going to retire? How much money do they need? And finding the right tax strategy that aligns with that. So, tax preparation is all about recording the past, recording what happened, and tax preparation can be difficult. There are a lot of nitty-gritty details that you need to know about preparing a good tax return, and that's super important. And remember, that keeps us out of jail. That keeps us out of hot water. It's really important to have a high-quality tax preparation. The tax planning is about the future. So we know that a certain amount of tax strategies are available, right? How can I help my client legally meet the mark for that going forward? And is that strategy appropriate for that client? So overall, there are a plethora of opportunities, but you have to overall need to know if it's defendable and how the IRS views it. So that's what we do here. Give us a call. We get excited about doing this work with you, and we love saving money and winning. Wonderful. Thank you.